Are you wondering about how we calculate risk in finance theory? In this video, we will look at how we use beta in finance theory as a measure of risk. In finance theory, asset pricing models are designed to calculate a required return for an equity investment in a firm. They do this by calculating the risk premium for an equity investment based on its sensitivity to the systematic risk of a fully diversified market portfolio, called its beta. No one can calculate a firm's beta precisely. I'll say that again. No one can calculate a firm's beta precisely. The calculation of a firm's beta is based on looking at the past variability of a firm's listed share price relative to the share market overall, and assuming this relationship will continue in the future. This beta of a firm is then multiplied by the market risk premium to calculate the risk premium for an equity investment in a firm. This is then added to the risk-free return to calculate the equity cost of capital for a firm. The required rate of return for equity comprises a risk-free return, which can be related to the long-term return on government securities, and a premium for risk. Quite a few equity investors, me included, would say, who cares about a firm's beta? Even if it was possible to measure it convincingly, which is at best highly questionable, we should ask ourselves how a firm's beta would affect my view of the risk surrounding my equity investment in a firm. For example, suppose I arrive at a valuation for Ryman Healthcare of about $16 per share. If I was able to purchase shares in Ryman Healthcare at $12, I would have a significant margin of safety and a degree of protection if my forecasts of Ryman Healthcare's abnormal operating income or cash flows that underpin my $16 per share valuation proved to be optimistic. Alternatively, suppose I purchase shares in Ryman Healthcare at $15.95 per share. I would have a small margin of safety and little protection if my forecasts of Ryman Healthcare's abnormal operating income or cash flows proved to be optimistic. Although the calculated betas of Ryman Healthcare might be identical in both cases, the risks of my equity investment in each case would be very different. Further, the approach to measuring the risk of investing in a firm based on its beta relies on other people's judgments, namely on the movements of past listed share prices of a firm relative to movements in the share market. Listed share prices are simply the views of the marginal investor about the value of a firm's equity. A key tenet of financial statement analysis, and more generally of fundamental analysis, is that we base our assessments of firms on our own analysis of a firm's value. We ourselves need to know what adds value. We never hand this task over to someone else. Assessment of the risks of investing in a firm is a key element of financial statement analysis and of fundamental analysis of firms. The risks of investing in a firm cannot be understood without us understanding the risks of a firm's business. We need to admit the risks of a firm's business are incapable of a tidy, simple, technical solution through a simple use of beta and a weighted average cost of capital. For further information on how we calculate risk in finance theory, go back to Chapter 7, Section 7.3 in the study guide, and also review How to Predict the Future to Eternity weekly questions. Also answer, write and rate questions on how to predict the future to eternity in Peerwise.